Welcome to Build Your Wealth Muscle, a podcast dedicated to helping fitness entrepreneurs build wealth by saving taxes and growing their money. Each episode will break down different strategies in the areas of business, tax, and retirement planning specifically for your coaching business. Disclaimer, the topics covered in this podcast are for educational purposes only. This is not advice for your specific situation. Please consult a qualified financial or tax professional before making any changes to your financial or tax situation. Now here's your host, certified financial planner and tax advisor, Pat Darby. On this episode, you will learn S-Corporations and their utility for online business owners. We'll dive into why LLCs do not help with taxes, who should be an S-Corporation, and then finally, and most importantly, who should not be an S-Corporation. As always, if this episode helps you, brings you value, please do us a favor and share with a friend. Thank you and enjoy the show. How's it going? And welcome back to Build Your Wealth Muscle. If you're new, welcome. But let me explain, there's essentially two show formats. There's like this one, a solo episode where it's mostly discussing in-depth topics. Today we're going to talk about S-Corps, but that we can go really deep into topics, finance, tax, cash flow, some wealth planning. But then other times we'll bring on a guest and they'll be potentially an expert in some of those areas as well, like maybe coming at it from a different angle or different expertise, or a colleague of yours in the online business space. So today, again, we're going to dive into a solo episode all about S-Corporations. So we're going to break down first, the misconceptions. But if you're an online business owner and you're making over $70,000 or $80,000 and you're not an S corporation, you're probably overpaying in taxes. And this episode is going to be pretty beneficial to you to learn more about it, because S corps get talked about a lot. But let's back up and talk about like whether you need one or not. So first of all, an LLC does not save you taxes. So if you're a sole proprietorship or you're an LLC, from the tax perspective, it's identical to the IRS. So don't let people potentially push you into an S corporation sooner than you need to, because you think that you can't do things that you're hearing some of your colleagues or friends doing, and they're an S corporation. Or even if they're an LLC. Again, an LLC, this is a legal disclaimer, I am not a lawyer, so get legal advice from a professional attorney. But LLCs are asset protection strategies. They do not save you taxes. There can be a component to the LLC that you'll need for the S corporation. We'll talk about that today. But again, if you're just starting out in business, that LLC is essentially like the gateway to the S corp. So there's advantages to having it, but you don't need it if you're just, especially if you have a business that you may not be aspiring to make a lot of money. Like maybe you're running a little side gig at home and maybe it's making you 20, 30, 40,000 a year. And you're pretty consistently through your tax strategies writing off $20,000, $30,000. So the business isn't that profitable, but it's nice because a lot of the tax strategies are putting more than half that income as tax-free income. So in that scenario, maybe an LLC and the S corporation will never make sense for you. So that's something to consider as like a misconception, is like not jumping into it too soon. Okay, so what is an S corporation? It's not necessarily an entity itself. And this part can be very confusing, because all S corporations, like you can go to an attorney and say, hey, I want to form an S corporation, and they'll immediately ink you. Like you might be New Business INC Inc. versus a lot of your friends might be New Business LLC. So, but just be aware that all S corporations, this part gets confusing. They're either an LLC being taxed as an S corp, or they're essentially a C corporation being taxed as an S corporation. So somewhat trivial, but might be helpful for everybody out there that has an LLC, that they're thinking like, oh no, I got to like shut this thing down and go get an S corp. No, you can make an election. That's actually most common, that you make an election in your LLC for the IRS to treat you like an S corporation for tax purposes. So now, why do you even care? So there's essentially, when it comes to tax planning, there's kind of two different ways that you can tackle it. You can defer taxes, which is common with like K or something like that, like where you're putting the money in, you're getting a tax deduction today, but then somewhere down the road in retirement, you're going to be paying the taxes. You deferred them. Then there's tax avoidance, where you legally avoid taxes permanently. And that's what the S corporation is, because you're taking that tax liability and permanently lowering it. So the taxes that you saved, you don't kick down the road. You get that deduction today and every year that you're an S corporation. And again, you've legally avoided it. That's why it's pretty popular that people talk about these. So essentially, as a business owner, there's three big taxes that you're going to get hit with. You're going to get hit with federal taxes, federal income taxes, state income taxes, where applicable. Again, there's 9 states. I'm here in Nevada where we don't pay that, but most people in the other 41 states, they're paying some state income tax. And then the third one is self-employment tax, which is your Social Security plus Medicare. Inside of an S corporation, that third one, self-employment taxes, so think of the S-Corp and then S self-employment taxes, that's what you're sort of attacking with the S corporation. Meaning if you had $100,000 worth of profit in a regular LLC, all $100,000 is going to get hit with Fed, state, and self-employment. In an S corporation, in that same $100,000, you're going to have your income split, and it's going to be partly your W-2 salary that you pay yourself, because when you're an S corporation, you're essentially becoming an employee of your own business. And so now you're giving yourself a W-2 salary, and then a component of it is going to be your owner's draws. And so that same 100K is still your net profit, but only on those W-2 wages are you hit with Fed, state, and self-employment. On the other component, the owner's draws, it's just Fed and state. And so all that self-employment taxes for the first $184,000 is 15.3%. So it's not small. Now you're reducing that down, and all of that money that's not in your wages, you just save 15%, and you legally avoided taxation on them. So that's why it's very popular. So again, let's dive into the three benefits. It's going to reduce your self-employment taxes. The second one, which doesn't get talked about as much, is that it dramatically lowers your audit risk, especially, and the part of that is because it's a whole separate business tax return, and they're less frequently audited. And this becomes even more critical because the form that you fill out when you're not an S corporation, it's called a Schedule C. And as you cross that $500,000 mark of net profit, which again, if you're hitting that level, this S corporation is long overdue for you. But the higher you go up that income chain on the Schedule C, your audit risk is actually going up. So if you're working with a tax advisor and they're recommending the S-Corp and that's you're making hundreds of thousands of dollars of net profit, then the S-Corp is not just going to save you money, but it's going to dramatically lower your audit risk. And the third benefit, which might not be as appealing depending on what you're doing in life, is that if you structure your S corporation properly, you should only need one S corp in your whole life. So if you are entrepreneurial and you have your existing business and then you have a partnership with somebody and a partnership with somebody else, all of those partnerships can drop their net profits into your main parent company. That S corp can now become your parent company, so you can have your hand in a bunch of different businesses, and it all flows through a tax advantage S corporation. So what the social media world really gets wrong about S corporations is that they're not turnkey. And they're like, when you form an S corporation, there are administrative duties. And one of them, again, like I said, is the W-2. You have to pay yourself a reasonable salary. And it's actually a pretty big audit risk if you do not, because the IRS software is trying to, it's lining up, looking at what your net profit was, and then it goes straight to what you paid yourself as an owner's salary. And so if the owner's salary is zero, you're already increasing your audit risk dramatically. And that often gets left out because people will go in and just immediately jump into the S Corp, and they've never talked to anybody about the other setup, like running payroll, connecting to the state so that the state is also getting their unemployment insurance and things like that. Like, especially if you're here in Nevada, like that might come as a shock because you're used to paying nothing, but you still have to tell Nevada, hey, I got an employee here yourself. And then you start getting hit with some unemployment insurance and things like that. But all of that adds up to less than what you would save or what you would pay in regular insurance. The other part, again, you need to have a reimbursement system for like your home office, things like that. So all those administrative duties are, I don't know how to better term it, they're pretty annoying the first year. And that's why, like, if you look on a spreadsheet, if you were a computer and your net profit was like 40 or 50,000, mathematically it's going to make sense for you to be an S corporation. But the longer I do this, and I do this with clients with different organizational acumen and just general attention to like the accounting side and the boring finance side, there is administrative headaches the first year. Again, a lot of the S corporation rules, they're the same each year. So as you do it each year, it starts to become a little bit more simplistic and repetitive. But the first year, you're getting hit with a bunch of different tasks. So again, you have to start running payroll. And again, like companies like mine, we do all the setup for you and walk you through it. But you have a payroll. And now your home office and your vehicle, those things that you've sort of taken for granted by doing it in hindsight in prior years, now you have to write down what those expenses were or have the bookkeeping team do it. And you need to do an accountable plan to formally reimburse yourself. An accountable plan is the IRS's formal term for setting up a reimbursement system. Again, like you have to think about it from the eyes of the IRS. If you had a business with an employee and they had travel expenses or a home office they were writing off, you would need a formal plan to see what they paid and then reimburse them. They want you to treat yourself the same way. Again, it's not really a big deal, but it can be a headache when you're at like 40, 50K and you're like, all right, well, I'm going to save $5 or $6 grand, but now my administrative costs are $2 to $3 grand. I'm going to dive into that breakdown in a minute. So then you're saving a couple $1,000s. It may not feel like a no-brainer, but as you move up that chain, that's why I started the podcast. If you're making 80, 90K, now those numbers get dramatically bigger. You might be saving $10, $15, $20,000 in taxes. Now all those headaches are a lot more reasonable because you're like, it doesn't matter. I'm saving 15 grand. But here's where the administrative costs / headaches add up. So again, you're going to need a payroll provider depending on which one you use. Like I'm a big fan of Gusto. I think it's very user friendly. The initial setup can be less fun as you're connecting to the state, but after that, it's pretty smooth, especially with Gusto. But they're going to charge you $40 to $80 a month, depending on the plan you pick with them. The tax return for your business is going to be just that alone. That could be $800 to $1,500, just that component. Usually a personal return with the S corporation is going to be like $2,000 a year. So that has to be included into it. And I would highly recommend, like our firm as an example, if you're going to move into the S-Corp, in my opinion, your business should be able to have professional bookkeeping done at this point. One, because your business is obviously making enough money that it's not a great use of your time. But secondly, there's a lot of behind the scenes rules that S corporations have very specific bookkeeping needs because of how you have to run your payroll, how you have to have certain things paid for by the business. So again, that can be very administratively frustrating, but it's a no-brainer for people making over $60,000, $70,000, $80,000 a year in terms of the tax savings. Again, if you don't care about the tax savings, then the next ring on the ladder would be like, well, now you're making $300,000, $400,000, $500,000 a year net profit. You're increasing your audit risk with all your business success. So that's another reason it comes into the equation. But just factor that in, that you're probably giving away a big chunk of your tax savings to an accounting firm. But again, mathematically, you're saving more than you're paying out. But just be aware of those things. I think from my experience, it's the monthly accountable plan that drives people nuts the most. And I don't blame them, but it is what it is. Like that's what the IRS tells us you need to do to stay compliant with your mixed use personal items. So like inside of an accountable plan, the common things that go on there are like potentially your cell phone if you're paying it personally. It's anything that you're basically paying personally that has a business function. So a lot of it is home office. So you have a house or an apartment with 2 bedrooms. One is yours, one is the office. You're paying out of your personal checking account for that. And maybe that home office is 20% of your square footage. That has to be formally written off inside the account. So just bear that in mind. Again, the point of this is to get you to consider it. But I do want people that are on the fence to really understand what they're getting into, because even personally, I've had people jump into it and then they sort of regret it because of all the administrative headaches, because for whatever reason, that's not their personality doesn't match with all the administrative accounting homework, which is totally cool, but just be aware of it. And so here's more people. Let's go over who should not do the S-Corp. Again, like what I talked about, if your income's not high enough. And again, I highly recommend before you jump into it to really take a look at what your net profit is, because it's not out of the question that you have hundreds of thousands of dollars of top line revenue. But depending on how you run your business, like maybe you have a ton of marketing spend, maybe you're doing Facebook ads, Google ads, maybe you're traveling all the time to see clients, whatever it is. But you could easily have $300,000 of revenue and $240,000, $250,000 of expenses. And now you're whittled all the way down to like 40, 50K. I don't know if I would do it there. And more importantly, you don't want to jump into the S-Corp, then find out from bookkeeping, like, oh crap, I thought my net income was 250,000, but my net income was really like 60,000. Big difference. One, in terms of how much you're really taking home. So your cash flows are tight, but also now again, you're not saving nearly as much as you think. And you probably just paid an accounting firm a lot of money to set all this up for you. Because again, they're probably going to charge you also for the setup itself. Because again, they're doing a lot of work with your payroll and things like that. The other scenario, again, like if you have uneven cash flows, like if your business is 50K net profit, next year 300,000, then maybe 20,000. Like if you're all over the place with net profit, even though you're going to pay a lot in the good years, it's not a good idea, because again, you're going to have these administrative costs every year, no matter what your profit is. And it's quite a hassle to unwind an S-Corp once you've told the IRS you want to be one. And again, that's sort of what I talked about before. If you have no interest in the bookkeeping discipline and doing some of the other necessary things, it's probably not for you, even though, again, you're sort of walking away. In general, if that's your personality, you're probably overpaying taxes anyway, because for most people, it's fairly easy to track their revenue because they can see like what came in Stripe, what came in like Zelle or Venmo or whatever. But the expenses can easily get lost because maybe you used multiple different credit cards, different bank accounts, maybe you paid cash, maybe you cash apped or whatever. But missing or forgetting to write off legitimate expenses that you paid money for, like maybe you took a flight to visit a client and you forgot that you used like a personal checking account, not a business one. So if you're not disciplined with bookkeeping, you're probably overpaying taxes just because you're forgetting about legitimate deductions that you have. So to wrap up, let's sort of just talk about the timing of it. So if you're saying, all right, I want to be an S-Corp, or it makes sense to be an S-Corp, how does it all work? So let's go over the timing and the setup. So you're supposed to set up the S-Corp within the first 75 days of 2026 as we're recording this. You're going to want to do a timely election. March 15th is the deadline. Now, you can do it retroactively. The IRS does allow this. But even though they let you go back 3 years, realistically, you can only go back the year you're in because you need to run payroll. And there's no such thing as retroactive payroll. Like I can't go back into 2025 right now as I'm recording this in January 2026 and run a payroll, because a payroll provider, like no money moved, like it has to be a legit payroll. So that's why you would need to really only be able to retroactively elect it in the year you're in. Now, again, there might be some circumstance where you ran payroll, but you didn't elect it, and in which case, talk to your tax advisor. They'll probably be okay with doing it. Like, again, if you told me, like, well, I forgot to file for an S corporation, but I did run my payroll, like, okay, then I'd be happy to work with that type of client for that scenario, because again, like you have the critical part, you have the payroll. But then just be aware of this, because I started the podcast with this and I want to bring it back around. Having the LLC allows you to elect S-Corp. So some people call it like an LLC is S-Corp insurance, meaning you can purchase your LLC, let's say for hypothetical purposes, on December 1st of last year, you started your S-Corp. Or sorry, you started your LLC. So now January 1st, you have a brand new LLC and you just start doing business. And you're like, Pat, I don't know what my net profit's going to be. Like maybe last year, let's say your net profit was like 60 grand. So you're like, I don't know, like maybe I'll make some investments in like marketing. So I don't know where my net profit will be. And then fast forward to June and you're killing it. And you're like, all right, now I'm pretty sure my net profit's like well over 200 grand on pace for. We now know, okay, well, you have the LLC, you have it for the whole year. We can go back in, let's say in that hypothetical scenario in June, and we'll do a late election back to 1/1/26. Now, flip that scenario, you're running it out of a sole proprietorship. So it's your Social Security, you don't have an LLC. And you're like, same thing, like you're making 60 grand, you just don't know, and you didn't talk to anybody, you just had 60 grand. And now you reach out to a tax advisor in June and you're like, all right, I'm at 200K. He or she is going to have to run down the numbers with you, because it's still, in that scenario, it makes sense for you to go get an LLC. But now you've put yourself in a situation where you're going to have to see what makes sense, because the next 6 months is the only time period that you would be the S-Corp. So you're increasing your administrative costs, because in that scenario, that year, you're filing 2 separate returns with the IRS, because half the year, all your revenue and income has its own net profit in that Schedule C again, which is a regular sole proprietorship. The second half of the year, you're an S corporation, so it's not the full year's net income. So you have to really sit down and try to project, like, well, what is your business going to do? Not January through June, but June through June through December. Because if for whatever reason, maybe you landed a bunch of huge clients that paid in full in the first 6 months of the year, and now you're doing fulfillment, so your expenses are going to be higher, and you don't know what new revenue is going to come in those final months. You might still grab the LLC, because again, now you want to start making sure you're paying attention to what's going to happen for 2027. But it may or may not make sense for you to be an S Corp. You might have to wait a few more months again and be like, all right, because I don't know. Because that's happened too, where you go and you S Corp, and then the final 6 months, you don't really have the same revenue that you had in the first 6 months. But now you're filing an expensive S Corp return plus the less expensive Schedule C return the same year. And that might happen to most people anyway, because they might be like, well, in January, I'm listening to this podcast, so I lost a month or two, and now I'm going to have 2 months non-S Corp and 10 months S Corp. But the math might totally math out, but just be aware that the first year when you don't have an LLC at all, you might have that, I don't know, administrative headache and cost headache. But as a quick recap, I think S corporations are great, but they need to make sense for your business. And more importantly, you need to estimate the cost that it's going to be to do it for the first year. And I would even say in perpetuity again, though, they're going to pay for themselves each year, but you will have, in my opinion, you should have payroll, bookkeeping outsourced. And again, there's places like Gusto, they make the payroll side very easy. But getting professional bookkeeping, and if you're going to use a professional bookkeeper, I know there's AI and stuff out there now, but really do your due diligence that they specifically have experience with S corporations, because there's different types of accounting expertise that's required specifically for S corporations, because it has to all tie into the payroll. Like we didn't go in depth into it, but like when you start adding benefits like your health insurance, your HSA, all that, there's tax strategies inside of S corps that need to be done the right way from a bookkeeper's perspective. Otherwise, you'll accidentally lose the tax deduction with things that are all stuff you're paying for and are all fully deductible. But if you don't do it the right way, the IRS will just be like, well, you didn't put it in the right spot, so it's not a deduction. So anyway, I hope this has been super helpful. Obviously, reach out to my firm, Sin City CFO, if there's anything that we can do to help you convert to an S corporation, or if you just want to have a consultation with us to see if it makes sense. But anyway, hope you have a great weekend. Thank you for joining us this week on Build Your Wealth Muscle. The links mentioned in this episode are available in the show notes. For video clips and more information on tax and retirement strategies for fitness entrepreneurs, please follow my Instagram @thePatDarby. If you found value in this episode, please do us a favor and share with a friend. If you tag me, that'd be appreciated also. Lastly, for help implementing any of the topics discussed, please book a call. The link is also in the show notes. Thank you again for listening, and have a great day.